TD Economics has come out with its latest quarterly economic forecast, and dare I say it sounds even just a tiny bit optimistic, although I think that depends on the context of where we're coming from. Beata Caranci is chief economist at TD, and she joins me now. Was I mischaracterizing that? Is it a little bit optimistic?
It certainly is more positive for the near-term quarter being the third quarter. So this is where we're forecasting about 3% growth in the quarter, bearing in mind that we had a significant contraction in the previous quarter. And a lot of the reasons we're getting that bounce back is because of one-off factors. So for example, production coming back online from Alberta. We have the child credit benefits going out from the government in that quarter as well. So I think when you remove those factors, this is why when you look on beyond, the fourth quarter and into next year, we have growth coming right back down to 2% or slightly below that thereafter. So we're getting a bit of a pop in the near term, but I would not expect that to persist.
I tried to be optimistic. The dismal scientist came out at you and corrected me. Let's talk about some of the factors, though, that you cite in the forecast that are important for the Canadian economy. Sector rotation, I know you've been talking about that for a while. Are we seeing it?
This has been a huge area of disappointment. So, Bank of Canada economists have been expecting this rotation away from this high dependence on housing markets and the stimulus it's providing to the economy, and a movement towards export more led growth, and eventually that feeding into investment incentives as companies start to increase capacity in response to the export demand. That hasn't materialized, and in fact, in the first half of the year, the export sector was an outright contraction, and it caught everybody a little bit off guard in terms of where is this rotation coming from if it's not even growing slowly, but actually contracting. And we had some positive news in that just in the last month of data, where the exports are starting to show a little bit of a rebound. Manufacturing shipments have increased the last couple of months as well. So there's some life coming back into that sector. However, we've been fooled before on this. So I think many economists are taking a pretty much of a cautious stance on this. It's great. We're starting to see some growth in the export sector. You need it sustained for many quarters in order to get that rotation of growth happening with the dependence away from housing and less on consumer spending. So we're really thinking it's more of a 2017, 2018 story. And we've put in pretty conservative assumptions on export growth in a 2 to 3% range. We hope we're going to be pleasantly surprised, but we've taken a cautious stance just based on its own history.
You mentioned earlier about the child benefit checks coming out and just government spending in general. How important is that going to be for Canada in the near term and I'll say the mid to short term?
Well, this offers the greatest amount of potential in terms of where we could get upside surprises if it's executed well. So we have penned in about a 0.3 of a boost to GDP coming off of infrastructure spending or government spending in general for next year. So, we have a 1.8% growth profile for the year. For 2017, it would be 1.5% in the absence of that, which is basically not a great year. It's looking awfully similar to the last couple of years we've had. So we are counting on that boost in infrastructure spending. We're starting to hear from the government initiatives that are rolling out. A big announcement in Ontario was made a few weeks ago. And we know there's more still to come. But ultimately, it's how well that's implemented, which will give us an idea of those type of fiscal multipliers that we talk. For every dollar spent by the government, how much bang for your buck are you getting in the private sector? So while it's a positive element in the forecast, it's something that just requires constant monitoring to see if it's actually translating into a good economic boost. We think it will. Infrastructure spending is one of those areas that has very high fiscal multipliers relative to other areas. So it's one of the more optimistic areas that we could get an upside surprise in the forecast.
One of the areas, and I don't think, I think I'm borrowing a term, it's about a housing multiplier in the sense of, housing prices gone up so much, people feel more confident, maybe they're spending more on their house and that kind of thing. You talk about key housing markets to cool. So what is the inverse of that? Is there a housing subtractor or divider? I mean, if things cool down, well, how would that affect consumer spending?
So consumer spending, when it comes to housing, it has very long legs. So in terms of when you see house prices cool down, or in the case of Vancouver, correct, we're expecting about a 10 to 15% price correction in that market. The people respond with lags, meaning it's 1 to 2 years out before that wealth effect starts to feed through in the retail spending numbers to a great degree. For the markets of Vancouver, price corrections are, par for the course in that market. They get them frequently. It would be much more unusual for the Toronto market to see it. We're not accustomed to seeing the volatility in prices that they get in Vancouver. And the reason they get more volatility is because of the degree of foreign investment that flows in and out of that market. And that's sort of the marker that there is foreign investment occurring in there, that it can be fleeting. So we don't actually think it'll have as large a of a reversal effect in terms of market psychology and spending of consumer behavior as it would normally have. If you were to see a 10 to 15% correction in Toronto, which we don't expect, that I think would have a bigger effect on retail spending than when you see it in Vancouver.
What about the Bank of Canada? It seems, I think you say in the report that they keep hitting the snooze button right now in terms of what their policies are.
Yeah, we're not expecting the Bank of Canada to be doing much over the next 2 years, and in fact, we don't have them increasing rates. We've put in for pinpoint 2019, so quite a ways out, and that's provided our forecast transmits the way we think it is, meaning that we're going to get a really good rotation of growth towards that export and investment sector. So really, the Bank of Canada's caught between a rock and a hard spot. If they increase interest rates too quickly, then you undermine the rotation of growth to investment that you actually need to see. And if they cut rates to try to stimulate investment, they fuel the housing market. So we really feel they're in a holding pattern. The economy is relatively stable. You want to see the pass-through that we're going to get from the fiscal stimulus into the economy, what kind of multipliers we're seeing out of that. And they really have nowhere to go in terms of rates, or no incentive to move rates in either direction, and that's why we think 2019 is our best bet. You talk about in the global forecast in terms of what you're seeing. I think essentially it's, and I'm paraphrasing here, low growth, that the banks are going to keep on doing what they're doing, central banks are going to keep doing what they're doing, although with a lot less impact. But we're still vulnerable to political events like Brexit and US elections. So how could we see some of these other shocks, maybe not shocks too strong a word, but other events affect the Canadian economy? Well, this is the position that we're in Canada. As a result of having greater reliance on our growth coming from the export sector than we've needed in the past, we are more sensitive to what's happening internationally. So if you get a downside surprise in the US economy, we're going to feel it through the export sector. And in fact, the reason our exports did so poorly in the first half of the year was because US investment did really poorly, not the consumers. The consumers were spending at a rate of over 4% in the second quarter, but most of our export growth is actually driven from investment spending in the US as the primary factor, and consumer is secondary. So what happens internationally is more important today than it was even a few years ago when we could rely more on the housing side doing the heavy lifting and growth. So if we could start to see downside surprises on the global environment, that would certainly be a challenge from a Bank of Canada perspective, because then where do you get that export growth coming from? So it's a risk to the forecast.
Last thing I want to ask you, because everybody wants to know, of course, the loonie. We have had, if you look back over the last year and a half, it's been a roller coaster all over the place. Are we going to see some more steadiness, do you think, in the loonie against the US dollar?
Yeah, currencies are naturally volatile, but I would say if you want to think of it in terms of a range where we would say the upper side versus the lower end of the range would be, I think we feel when we look at the economy and the momentum there and the differential in interest rates we expect to see. So we do expect the Federal Reserve to be raising interest rates in December of this year, whereas the Bank of Canada will be not doing anything. And so that should drive the loonie a little bit lower. So on the bottom end, we think maybe in a range of somewhere between 75 and 77 cents over time. But it would not surprise me if it breached below those levels when the Federal Reserve is raising interest rates, because that would be the knee-jerk reaction of the result of having higher yields in the US relative to Canada. That would weaken off the currency.
Beata, thanks very much.
My pleasure.